to present a little course we have on long calls and long puts. Long calls and long puts. A little bit about us first. OptionVue was started in 1983 by Lentz, and since then, OptionVue Systems has occupied a very unique niche in the options trading world in the area of high-end options analytics. Starting then, OptionVue really it was and still is the most sophisticated options modeling software that the trading public can have. And over the years, OptionVue has made advancements in its modeling to stay ahead of the competition. And really, to get some of the things in OptionVue, you would have to be within a trading house that has their own programmers going at it with things like horizontal skew and all that stuff. Thanks, Alex. Appreciate it. What Discover Options is the educational arm of OptionVue, and we've been in the mentoring business for about the better part of 12 years or so, 12, 13 years, I'd say. And it's my pleasure to speak to you today about one of the beginning courses that we have called Long Calls and Long Puts, just simply going over several things related to simply going long calls, or buying puts. And so this is part of a $99 course that you could get that includes a live mentoring session with one of our mentors to better explain things and customize it to you and what you're doing. And but we're offering it today at no cost, and then it'll be archived, but it is part of a course that you can get that includes some actual hands-on mentoring. So check out our website and check out the specials that we have going on in that regard. All right. Now, long calls and long puts. Now, how do I advance? Oh, I see. I'm using a PDF here today instead of a, I might have to go to the thumbnail thing and then just click here. Boom, there we go. Hopefully that'll work for you guys. All right, philosophy. I want to review quickly our philosophy at Discover Options, which is the way of the gridiron. We like to relate options trading to football because just as football is a contact sport in a physical sense, options trading is a contact sport in an emotional sense. And the preparation to being a trader and the preparation to being a good football player are very much along the same lines. And so in football, often the team will get together and do a chalk talk, and they have to learn the plays first. And then they go out to the practice field and they'll practice using various drills to get good at the skills that they need to succeed in executing those plays. Then when they have the plays down, they scrimmage against other teams in an informal setting. If you watch the NFL Network, you'll see them playing 7-on-7, 9-on-9, finally 11-on-11. The media might be there, they might not. They're just scrimmaging each other to get better. And then finally, after they scrimmage, they do the exhibition games, and then it's off to play Monday Night Football. You just don't go from learning in a webinar like this one to trading huge lot trades. There's a process you got to go through in the middle, and that Discover Options mentoring, that's what we lead people through, is the process of learning and then practicing, scrimmaging, and playing. And so in the world of practicing with options, we want you to do basically paper trading using OptionVue's BackTrader program. We have saved option races every trading day since January of 2000 and January 2001. And you can walk through your strategy going through 9/11, the summer of 12. You could go through the crash of 08, August of 2015, and see what it does to your strategy to walk through those periods. But you practice. The point is you're practicing using no money, informal context, and then you're ramping it up to where you're then scrimmaging in the markets using 1- and 2-lot positions. So if you lose, you don't lose that much. Just like a team taking the field exhibition, if they lose, it doesn't mean much. Okay, and then finally you're ready for Monday Night Football, and trading means ramping it up, ramping the contract size up to a level commensurate with your portfolio level. Okay, and Jim Graham just posted the new basics mini courses, and there's the link. Go ahead and you can click there, and if it's archived, I think you can even, in an archive sense, click there as well. Here's the outline of what we're going to do today. We're going to talk about why you buy calls and puts. Why should you consider just going long calls and puts? Aren't spreads the best way to go? Risk and reward possibilities of each. We'll review which month or week you would buy. Now today, we're going to deal with the months only. We're not going to get into weeklies. I'm using an example involving stocks. Back then that we had just monthlies listed on the matrix. So what month do you buy? We'll go over delta. We're going to go over which option to buy, whether you should consider an at the money, in the money, or out of the money option, in what scenario. We're going to talk about a few strategies regarding follow-up action. All right, if you're losing money, how can you defend yourself? If you're making money, how can you be more offensive in protecting your profits and so forth? And we'll do a quick review of order types at the very end. All right, so that's the layout. I have a whole bunch of slides for us to get through, but if you just pay attention, and if you're watching the recording, you could just hit pause, take a little break, because it is, this is kind of involved and it's progressive in nature, so I fully understand, certainly. Why would you buy calls and puts? One word, folks, leverage. Buying call options or put options allow you to employ leverage, which can cut both ways, and you'll find that out in lickety split here. Just to review, the call buyer has the right but not the obligation to buy 100 shares of stock from the seller at a certain time, that's the expiration date, for a certain price, that's the strike price. All right. The seller of the call or the writer is obligated to sell 100 shares of stock should the buyer so decide. The buyer pays a fee called a premium for this right. Okay, so if you're a call buyer, you're going to make money if the stock goes up. All right, we're going to show that visually how that looks. Let's go to puts now. Put options. A little bit different here. Calls, you make money if it goes up. Puts, you make money if it goes down. So the put buyer has the right but not the obligation to sell 100 shares of stock to the writer of the put at a certain time for a certain price. The seller of the put has the obligation to purchase the stock at that strike price if the buyer of the put exercises the option. The put buyer pays a fee called a premium. So kind of twist your brain around it a little bit. A lot of people just buy calls. They're long only type folks, and that's great way to get into it. When I started trading, this is how I traded. I traded by buying calls and buying puts, and I was using basically a trend line breakout system at the time. Very simple. All right, and that's how a lot of people get started in this. Here's an example, and I want to use Halliburton back when it was at 49. This is an example, and I could have put ABC stock, and a lot of folks in the education world just will put XYZ stock or ABC, something like that, and I could have done that and make it truly a timeless example. But regardless of where Halliburton is today, the example is timeless. So here it is. If you were to buy 100 shares of Halliburton at $49, your investment is then $4,900. Okay. Now, if you were to go into the April calls in this example to the 49 call, it costs $1.44. How many shares does a contract control? 100. So it's $1.44 per share. Per share. Now, the contracts most always control 100 shares. That's the standard put out by the CBOE that controls all this. Occasionally, you'll get splits and things like that, mergers, acquisitions, whatever, and sometimes, not splits, but when you have takeovers, sometimes then the number of shares controlled by a given contract might change. And so that's something you should be aware of. Usually then the contract strike price will change as well. But almost always it's 100 shares per contract. So if it's $1.44 per share, each contract controls 100 shares. How much money out of your pocket are you paying? $144. Let me look at my next slide here. Okay, so look at this. To control 100 shares of stock costs you $4,900 by buying the stock. By using call options, you can control the same 100 shares for only $144. That's tremendous leverage then. All right, not too bad. Let's go to the other side. Let's go to shorting stock. Let's say you're bearish and you want to take advantage of the market here. Find us some sort of instrument in the market to take advantage of your bearish position on Halliburton. Okay, you can do one of two things. One, you can short the stock, and in this case, the way you consider the margin is you take the dollar amount to purchase the stock times 1.5. That's the gross, and you can see down here. Now let me, okay, right here. Let me grab this. So there's the gross right there, 73.50 minus the cash flow that you're bringing in. You're bringing in 4,900. Okay, the net requirement to then short that stock is 24.50. To short that stock and take advantage of a bearish outlook that you might have. Now, the other thing you can do is to purchase a put option on that stock. And here we have the puts. Okay, and the at the money 49 put is priced at $1.46 per share. So if you were to buy that for $1.46 times 100 shares, it's $1.46 per share. Each contract controls 100 shares. It's $146 to control that. So it's $24.50 to short the stock. It's $146 to simply buy the put to control the same 100 shares there. And so that's what you have. Tremendous use of capital in leverage to take advantage of an outlook. Now, there's a caveat here because leverage cuts both ways. And understand that we have to use OptionVue to look at the risk and reward possibilities in the form of a graphic analysis. So here is a graphic analysis of the screen showing you what it would be like to go long 100 shares of stock. To go long 100 shares of stock. And so real quick, on the x-axis at the bottom, you have the price of the stock. On the y-axis, you have the amount of your profit going up above the zero break-even line. Then you have the amount of your loss going down below the zero break-even line. And so this is somewhat intuitive. Let me get a different color here. This is kind of, here we go. It's somewhat intuitive. If the stock goes up $1 and you own 100 shares and it goes up $1 a share, how much is your profit? It's $100. You can kind of see over here, it's right around at that 100 mark there. You see that? If the stock goes down $2 a share and you own 100 shares, how much have you lost? $200 right there, okay? Well, you could say we're right about at the $200 mark, right around there. All right, so that's how you read these risk charts. Now, let's look at the long call position. Here is the risk chart for owning that long 49 call that we just discussed. They purchased at $1.44. And as you can see here, we're showing three different lines here, dotted, dashed, and solid. And you can see the little key. Let me get yellow. You can see the key over here. T plus 0 is today plus 0 days. And you can kind of tell. Let me make sure I understand what my next slide is. Perfect, okay. If today the price of the stock goes up $1, how much would we make? We would make $60. You can see here, right? There's the number. Okay? And that's what OptionVue is doing, is it is modeling theoretical prices as of that scenario. And in fact, all the scenarios, going on out. You could take this little wand and move it around, and you'll see a little drop down box that'll then show you the profit or loss down to the penny at any price along this spectrum here. If Halliburton goes down $2 today, what would our loss be? Well, we can model it right there. You could see we would lose $82. And that's what you're seeing at the T+0 or today's line. Now, notice, want you to notice that dotted T+0 line is above the next line, which is dashed. Now, what does that mean? What does that mean? The dotted line is moving toward the dashed line. What that's reflective of is over the course of the next 9 days, you have time decay wearing on that time premium that you're paying. All $1.44 of this option is in the form of time decay or extrinsic value. As time goes on, what happens to that extrinsic value? It goes down. And that's reflected here, so that by the time we get to T+9 here, if the stock hasn't moved, let me go to the next slide. I'm now focused on this line. If the stock hasn't moved, we've actually lost $43, or what, something approaching 30% of our money, just from time decay. Just from time decay. And here we're modeling the potential of risk and reward as of 9 days from now. So that if in 9 days the stock goes up $2, we would end up making $93 instead of the more profitable, what looks like about 130 there, if it moves quicker. So it's important that we understand the risk and reward. Look how much we could lose in 9 days if it goes down $2. We've almost lost all our money. We would be losing $116 at that point. So this is important to understand reading these charts. And also there's the expiration break even there. Okay, the expiration break even is something to understand. Let me just get rid of these lines a bit. And let's pretend we're looking at the solid line underneath. I don't want to give it away too much. Don't want to give it away too much here. But you could see then at the at the solid line here and here, okay, there's a break even point right there. And what you'll note then is that the amount that we're losing, we paid for in total premium, given that this is an at-the-money option, is the same amount coming over at $1.44 in this particular case. Now, in the current version of OptionVue, we have the break-even box down here that enables you to see the number poking up right there, and it's pretty cool. But that's the break-even part here, and that when you put this options trade on, you should kind of have in your head where the stock needs to go before you start making money. And in this case, we need it to go that full $1.44 and more so to make some money over here. All right, and there it is, the $144 that we would lose if it doesn't move at all to the upside. Now note here too, in terms of leverage, what's so nice is just look at how much you could make on the upside. This is just awesome. This is the awesome part about buying calls, is you theoretically have an unlimited amount of money that you could make if the stock goes up. Yet, if the stock goes down, your loss is limited no matter how far down it goes. Your loss is limited to that $144. And that's just awesome. Look at this. I mean, you know, you don't even have to move a standard deviation to double your money here. You see that? I mean, you don't even have to move a standard deviation, which is the purple here, to double your money in this case. And then if it goes out farther and farther, 2 and 3 standard deviations, you're doubling and tripling your money, theoretically quadrupling it if you get out really wide. So that's a huge part about an advantage for just going long calls and long puts. Now, I want to compare. Something we can do is up here. We can click this yellow arrow and go back to the long stock, or click on here and click on superimpose, and we can bring back our stock position and superimpose it on top of this, just like that. And what we're looking at then is the long stock in blue. We're looking at the long call option in red. And when you do this, it's very important that you come over here in OptionVue and click on this vertical axis button and make it say yield. Because think about it, to go long the stock costs $4,900. All right, $4,900, and to go long the call costs just $144. And yet, if it goes up $1, a $1 move on a $144 is going to make us 45% on our money, whereas a $1 move on just the stock position is going to make us just a let's see, well, $100 on a $4,900 investment, and the yield is not near as what it would be in the going long the call. So that's a suggestion, is when you hit superimpose, come over here and compare apples to apples this way. All right. Now let's go to the other side. Let's say you're bearish. What can you do? There's two things you can do. You could short the stock or buy the put. Shorting the stock, same kind of modeling. You're making money as the stock goes down. Boom, boom, boom. If it goes down $3 in what, 18 days, you're going to make 12% on your money. Again, I've set this to yield over here. Okay, now we could go long put and superimpose it. And here you could see just the same way, it's just inverted from the call position, except with one big difference, is that this stock can't go below 0. You can make a lot of money in these puts, but theoretically you do not have the infinity part to this. There is a limit to how much you can make, and that is if the stock goes all the way down theoretically to just a few pennies. And then this, you know, that's so far out there, it's really of no concern. But that's kind of what I think you can see here. You're limited on the amount of loss in the put to that $146, yet you can make several times that if it keeps going down and down and down, or further and further. All right, and then likewise you can compare the yields and all that together. But that's a beautiful, beautiful tool in OptionVue to quickly superimpose trades and evaluate your perspective and whether that option trade is best for you. Okay, so that's the risk and reward, and we just have to understand that we have to watch those. Now, when you go to buy calls and puts, typically you're doing it based upon, well, based upon what? Some of you might read the news. Some of you might throw darts and flip a coin. I don't think so, though, knowing option traders like I do. Some of you might have a technical system where you are watching for trend line breakouts or the stochastic rolling over, something like that. I actually work with one gentleman. He's on Reddit, and that's one of the things people do. It's the largest, I guess, forum for discussing things on the internet, it's Reddit, REDDIT. he goes to some Reddit rooms or forums, and there's day traders on there just throwing out their news ideas. They got their ear to the ground on every news source in the world, and they're throwing stuff out on Reddit. This guy actually day trades penny stocks using Reddit. So many different things you can do to get an edge of some kind. But regardless, you have to fit your perception of edge or your documentation of your edge, fit it to trading in the correct expiry, whether it's weeklies or monthlies. In this case, we're going to explore which month you're going to purchase your call or put in. All right, so let's explore that a bit. Here you have a choice between April or July, and we're exploring which call to purchase. Now, just as a pop quiz in your head, what's the expiration break even for each of these trades? That'll kind of start giving you a clue as to kind of where we're headed here. So if the stock is at 49 and we're at a 49 put, we're going to buy that for $1.46. How much does the stock have to go down for us to make money? Okay, it has to go down at least this $1.46 coming off of that 49, so that would be at 47.54 would be the break even, right? 47.54, it would have to go to that price in 18 days for us to make money on this or begin making money. Now, out in July, we've got 109 days. The premium is 375. So I think we're looking at 45.25. 45.25. So depending on your approach to analyzing the underlying, that's going to make a huge impact on which expiry you go to. Which are you more certain of? The thing going to, what do we say, 47.54 in 18 days or 45.25 in 109 days? You have to have that question answered before we can start choosing these, selecting these here. So here's an example of the closer put at 18 days. And you can see our break even, but we only have 18 days for it to get there. All right. Now, I want to, and then here's the 109-day mark. The 109-day mark. Now, I'm going to compare these, but I want to make an observation. We're going to compare the 18-day option to the 109-day option. I want to show you something real quick, and that is this. N is near-term options. For at and near-term options, time decay occurs at an accelerating level. So watch this. I'm going from today to 27 to 55, 82, and 109 days. The first 27 days, you just don't have as much time decay relative to what you're going to get for the following 28 days between the second two lines. And then that distance gets wider as you go from the following two lines. And then finally, between 82 and 109 days out, you have a huge distance equal to the first 55 days by itself there. So a huge drop off. So at the beginning, your time decay isn't that much, but then it begins to accelerate over time. Keep that in mind, because as this thing drifts further, if you were to lose money, it drifts further out of the money, these lines get more, they kind of begin inverting a little bit. You don't have that same kind of effect if this thing drifts further out of the money. And that's what you're visually seeing here, isn't it? Visually, you're seeing that it inverts such that at the beginning, most of the time decay is at the beginning and very little at the end. You see that? The distance between the last two lines is much greater here, and it's the narrowest as you get over here. So I just wanted to point that out. Let's compare these two right like that, and what I'm doing is I'm taking this longer term option and I'm going to set this to T plus 18 days. So instead of looking at this expiration line date out to July 16th, I'm going to hit T plus 18 in this maximum projected box. And boom, what I'm doing is I am looking at that distant put as of T plus 0 and T plus 18. And I'm looking at the April put as of T plus 0 and T plus 18. Very simple to do. Once again, when you're in here, just click on this projected date and put T plus 18. That'll change this around. Hit superimpose, and then Shazam. We're now looking and comparing apples to apples. If I'm bullish or bearish, which option should I purchase? Excuse me. If I'm bearish, which option should I purchase? The distant July or the nearer term April? And so to answer that, I'm going to make a few observations here, okay? Let me erase this and kind of clean things up a little bit. All right. Boom, boom, here we go. Okay, notice if you were to buy the more distant red one, it's the more distant put. Well, let's start with the nearer term, excuse me, the April. Let's start with the blue April one. In the blue April one, if this thing were to immediately move down $2, oh, wait a minute, excuse me, time out. Let me look at this. Boom, boom. Okay, wait a minute, time out. Oh, I did that and that. Okay, I just got to make sure I understand where I am in the progression of slides. Sorry about that. If the thing moves down quickly, let's say it goes down today $2 to here, you're going to make about 80% on your money. Okay, if you have the nearer term. If you have the more distant one, you're only going to make something closer to 30%. Big difference there in terms of yield. However, consequently, if it fails and it goes down $2, or excuse me, goes up $2, you're going to lose 45% versus maybe 25%. So here's the deal. The more certain you are about an immediate move, you want to gravitate toward the shorter term. If you're less certain about an immediate move, you want to make sure you're not going to lose so much of your yield here if you're less certain. So then you want to go farther out in time. Make sense? If you're less certain and you're going to give it a little more room to breathe, you don't want to lose a whole lot. And you want to be farther out in time that way. We're going to quantify this into some rules in a little bit. Let's look at the calls. Okay? We're contemplating two call options, a short-term one in April, longer-term one out in July. What's the expiration break even for each of these trades? Okay? Stock's at 49. We're buying the 50 strike. Okay? We're buying the 50 strike for 98 cents. What's the expiration break even? How much does the stock have to go up for us to begin making money at expiration? Okay, we have to take the distance that it's out of the money plus the premium that we're paying. Okay, the distance out of the money, $1, plus the premium that we're paying. So for the front one here, it's going to be $51.98. 50, right? 50. Is that right? Let me click here. No, 50. It has to go up $1.98, $1.98 to the price of $50.98. That's it. It has to go up $1.98 to hit $50.98. Okay. Here it's got to go up to $53.20 to break even. And so that's kind of what we're saying, are you more certain it's going to hit $50.98 in 18 days from 49? Or are you more certain you're more comfortable giving it 109 days to go up to 53.20? Okay, that, depending on what kind of a trader you are, that's going to have a huge impact. So let's do the same analysis. Here's the shorter term, T plus 18, the shorter terms option, using $1 increments here. Here's the more distant one. We're going to come over here, type in T plus 18. It then creates the solid lines much closer. We superimpose, and there you have it. This is a great exercise when you're contemplating this, just to kind of understand and compare this risk graph to your analysis, regardless of how you're trading, fundamentally, technically, whatever, news. You want to analyze your trades by using the superimpose button there. All right, and so same thing. How certain are you it's going to go up to that place that we said 50 over here versus, look at the difference here in that we would have T plus 18. Oh, yeah, if it doesn't, yeah, I mean, look at that. Oh, 53.20, what was it? 53, oh, that was at expiration, I'm sorry. Clearly, if you think it's going to go up dramatically, you can make a lot more money quickly than you would going out in time. So that is here are the rules here. The more certain you are about an immediate move in the underlying, then the shorter the term you use. The less certain you are, okay, then the longer term you use. And just write this down if you need to. More certain equals less time. If you're less certain about the immediate move, then you give yourself more time. Real simple. Okay, now we're going to go to understanding delta and then kind of quantify this between delta and time to give you a better little grid here. Besides just these two rules, we want to talk about going from day trading out to investing. All right, let me get a sip of water here. 1 second here. Delta. This is an important concept in determining which call or put to purchase. Delta, I'm sure you've heard of it, the Greeks, as they say, the Greeks. Delta is the amount by which an option will increase or decrease in price if the underlying stock moves 1 point or $1. Delta is an essential tool in deciding which call or put to purchase. So it's the amount by which the option will increase or decrease in price. All right, look at this. So in OptionVue, you can create a format, and we do this for all our mentoring students, to go to a format that shows the delta for each option. And what I want to point out here is that the at-the-money options generally will have a delta of around 50. Now, in the academic world, in a lot of options textbooks, the beginner ones, they will say that the at-the-money strike will always have a delta of 50, because theoretically, you have a 50% chance that the stock will go up or down from that at-the-money number, correct? Well, when you get right into it and you start modeling this stuff, in OptionVue, we use what's called true delta. And if you look carefully, you could see that the price of the options reflected in their implied volatility varies from strike to strike. And in the model that gives you a 50 delta, it's assuming that these are all the same and they never move. We know that not to be the case, but in OptionVue, we look at the differences in these strike to strike implied volatilities. We treat that vertical skew with a great degree of seriousness, such that we then create delta figures that are more reflective of reality and what truly happens. All right, and so these are the amounts, 53, that's the amount of dollars or you would make if that contract that controls 100 shares, if that contract goes up by $1. Okay, if the stock goes up $1, this contract will basically go up 53 cents. By 100 contracts, you would make $53 then. Okay, that's how we do it in OptionVue. In other models, it would be 0.53, but then you have to have the 100 shares kicking in, and that's why in OptionVue we multiply it by the 100, and there you go. That's why it's at 53. Note too that as you go farther out in time, the deltas can change a little bit. The deltas will change as you go out in time. And that's, again, some of the more sophisticated modeling that OptionVue uses. We just don't ascribe a 50 to those at the money strikes. We try and blend in real life volatility situations, the vertical skew, horizontal skew, everything to give us a true delta. Okay? All right, so the deltas vary. I wanted to show you too that the deltas will vary as you go from, this is very important, as you go from being at the money to then going out of the money. I want to show you this as well. So here we are in the calls. As we go out of the money here, notice how the deltas will begin to drop. They'll begin to drop so that you're way out here at the 60 call. Okay. There's a very, very small chance that that's going to end up making money or finishing in the money. That's why the delta is so small right now. Is if the stock begins to go up, that delta might rise a little bit, but as the stock then goes down, that delta gets less and less because the chance in 18 days of that 60 call being in the money is very, very slim. Likewise, the in the money options have a much higher chance of finishing in the money and paying out. And so then the deltas are much higher as you go further in the money towards 100. Okay, and they'll go into the 90s even, where it's approaching 100% that it'll finish in the money. Theoretically, it'll never get to 100. Theoretically, but you could certainly get into the 90s there the deeper in the money you go, because a 44 call has a very, very high chance in 18 days of finishing in the money. Okay. All right, so that's the deltas as they vary up and down. And then in the puts, you could see the same phenomena. As you go out of the money in the puts, the farther out of the money you go, the less of a chance it has of finishing in the money. The deltas are much less. As you go in the money in the puts, it'll approach 100, and look at that, it's at 100. It can go to 100. Look at that, that's all right. Well, I know why it's 100, it's because of the way the pricing is. But theoretically it shouldn't, because you just never know what's going to happen. But because of the way the pricing is, it hit it at 100 there. Okay, and anything else we should cover? Oh, notice too, these deltas, as you go farther out in time, the deltas will rise. See that? The farther out in time you go, these out of the monies get more delta. See that? Now, likewise, the in-the-money options, if an option is deep in the money right now, it has a very high chance of finishing in the money. But if you give that same contract more time, you're giving the thing more time to drift out of the money, and then your deltas will begin to go down. See that? Isn't that interesting? Okay. And you could see the same thing up in the call. So that's delta. And I'm showing you the verticalness. Oh, I kind of jumped ahead of myself. Out of the money options have lower deltas. We covered that. Oh, okay, let's cover this. Position delta. To get your position delta here, you simply take the contract number you have, multiply it by the delta for that single contract, and that'll give you your position delta. So this is the dollar amount that your position would change in theory if Halliburton went up $1. Okay, if it went up $1, that's the dollar amount of exposure you have. Or if it went down $1, that's where you would be. So that's your exposure there in terms of risk and reward. You are long 424 delta. You want it to go up. Okay, and when you go to, and then visually, what does the delta look like? Visually, that 424 looks something, now here it rounded a bit differently when we went to this slide here. It's a little bit over it's 480, okay? But there you go. It's because I think as we go up, the deltas change a little bit as we get higher and higher. But you can see here, visually, delta reflects the slope of this line here, of the T plus 0 line, which is what we're focused in right now. It reflects the slope. We come over $1 and we go up, and that reflects slope. The two lines, the angle of those lines reflects the slope. Now, what's my next slide here? There you go. Visually, delta is represented by the slope of the risk line. Now, what can we show you here that's interesting? I know, I want to show you this. Notice that the slope right here is at a certain steepness. And if the stock were to go up, and we were to eventually begin making a lot of money out here, the slope out here is a little steeper than it is right here. And you can see that the delta then gets higher as we drift further in the money. Do you see that? And so this steepness is greater than this. And if we were to lose money and this drifts out here, notice that it begins to get flat out here. And that's reflected in the lower delta numbers. So a flat delta, which is the break-even line, or the 0 line, you know, when we're losing all our money, that's flat. That delta is 0, completely 0 at that point. And then here, it'll be at a delta of 100. That's the steepest we're going to get, is right at expiration break-even. And that's what I'm showing you here. In this case, 8 times 100 is 800. 800 delta. Down here, our delta is 0. So visually, it's the slope of this line, these lines, that delta is reflective of. Okie dokie. Here we go. Let's say you're seeking some delta here. Which option gives, now the animations are turned off. I just want to point out here, to get to 530 some delta, you could go long 100 of these out here at 5.33, or you can go long 8 of these more distant in the money calls and get the same delta as going way out here. Now, when you model these two, they'll look very different in terms of time decay and how much delta changes over time, but at least initially, you should be aware that to acquire certain numbers of delta, you have a lot of options available to you and contract sizes to acquire equivalent levels of delta. So when we make our choice as to what options to purchase, okay, that's something we're going to consider, is that we can acquire delta in any number of ways, but we know that we want to get some delta. So which option to buy? An at the money, in the money, or out of the money option? Okay. Great quote here by Larry McMillan, and I wish I could just change a few words and give it to myself, but sometimes, you know, great options educators and someone like Larry's been around decades doing this, and he wrote a book I'll point out at the very end. They just nail it. So here's the deal. The shorter term the strategy, the higher the delta should be of the instrument used to trade that strategy. Okay, once again, the shorter term the strategy, the higher the delta should be. So let's just look at a grid here. Day trading, let's say you're day trading. It's very hard to day trade options. You have the bid and the ask, you have fluctuations in volatility, the delta can fly all over the place. It's not frozen unless you're so deep in the money that it's going to be pretty much frozen, but it's difficult to trade options. And even then, if you go deep in the money on those options, the bid and ask spreads are just unwieldy, very difficult. So we suggest using the underlying if you're going to day trade. If you're swing trading 1 to 7 days, use the in the money options in the front months or the weeklies, depending on what you're trading. Okay, you can go to just look at the expiries, look at the open interest. Okay, go to the front expiries using in the money options if you're only trading 1 to 7 days out. Intermediate term, 2 weeks to 2 months, at the money options in more distant expiries. All right, and you're going to want to model ones versus the others, but if you're looking out 2 weeks to 2 months in time for your investment or in your trading, okay, consider using at the money options in more distant months. If you're out long term, 3 months or out there more, well, then you're going to want to use slightly out of the money options going way out in time, then even out to leaps. All right, 1, 2 years out, go out of the money in leaps, going way out there, and that'll probably be your best bang for your buck, is to ascribe to something like this as your is the way to go here. Okay. Here's an example. Day trading, you would trade the underlying. Short term, you would come to the front month. Again, if we had weeklies, you can consider those. But you're going in the money on these where your deltas are at 80 or above. Intermediate term, we're going out farther using at the money options. Longer term, we can come out even farther or even go use leaps. And again, you come out of the money and consider those. So that's kind of a good guideline in terms of deciding which caller put to purchase. Couple things quick. Follow-up action, defensive and offensive. Let's say your long calls or long puts, things go your way, you would be offensive in protecting. If it doesn't go your way and you're losing money, okay, you have 3 things you can do to defend yourself. Okay, 1, you can exit or limit your loss. Okay, this means just having a stop loss in your head or in your broker's platform. Boom, you're out, that's it. Okay, and we suggest doing that. That's always option number 1, alternative number 1 that you should strongly consider. If you're losing money and your outlook is changed, then by all means, just get out and go to the next opportunity. Now, if your outlook hasn't changed, I'm going to show you an example of rolling to a vertical spread, or you can sell premium in a nearer month and create a diagonal type spread. I'm going to show you examples of all these. Okay, here we go. Again, you're losing money and you're going to take defensive action. So here we have a trade in Apple back when it was then. Again, I could just put ABC stock, never mind that. We're going to begin by going long this option at $20.25. $20.25. We move forward in back trader to a place in time where we are now losing $420. We're losing roughly, what, 20% on our money, something like that. Okay, not too good, not too happy. There we go. What? Yeah, we're losing some money here. So what can we do? Well, first we could just simply get out, close it down, take our loss, go to the next opportunity. Boom. Don't even, just pull the trigger and get out. But if you're still bullish on Apple, it's gone down a bit. If you're still bullish, here's an idea for you. You roll to a spread for no cost or even a credit. Roll to a spread for no cost or a credit. Here's what we mean. We're going to go to this long option that we purchased. We're going to sell 2 of them so that now we are minus 1 of those. And we're going to then go in the money, or we're going to go further down and find the correct strike for us to purchase such that we're left with a net credit, or at least no cost. So look at this. We've sold 2 of these for $16.05. We brought in $32.10. We're now going to go shopping for one option that we can purchase for $32.10 or less. We don't want to do it for a debit here, so this is out. So all of these above it are in consideration. So we're going to go shop and we're going to model these and find the one that we like the best. So I'm going to go to the one just squeezing it in that's barely for a credit. And when we do that, it's going to reduce our amount required by just a little bit from 2,000 to 1,850 something. Okay? And we're left then with a debit spread, a call debit spread where we're long this one and we're short this one. Okay? Now, when you model this against the losing call position, here's what you got. Currently, we're in the blue. We're at the blue line here, fairly sloped. We're going to lose a lot more money if it keeps going down. And if it goes up, we need it to go up to this expiration break-even point for us to make money. If it fails to do that, we lose money. And in fact, every day that goes by, we're losing more money until we've lost all our money right here. Now let's compare that to the red line, which is our new debit spread that we rolled into. Okay, and note what's happened. We now have flattened our red line a little bit. Our T+0 line is now a little bit flatter. Our expiration break-even point went from over here to over here. So if we think that now the stock is going to begin going up again, but we don't know at what pace, we can at least now make, looks like 35% on our money if it begins to recover even just a little bit. See that? Not too bad. Not too bad. We don't need the stock to go all the way back up to that original expiration break-even point. Our break-even was rolled way back, and we're going to make some money here. We won't make as much as if it blasts off. Well, that's okay. But this is a great idea if you're still bullish and you want to stay in it. Roll down to a debit spread like this, stay in the game, and you're in it for less money than you originally laid out for the call. Okay, that's one idea. Other idea is to sell premium in a near month. So we're long this option out here. We're losing money. Okay, we go to a near expiration, weekly or monthly. We go to a near month. We walk out of the money and we start selling premium out here so that we're collecting time premium here and helping to pay for the losses over in this one. See that? And when we analyze this, This is what we have. We're losing money right now. We're underwater 20%. Immediately over the next 25 days, we can see that our time decay is positive. We can actually start making some money back, which is nice. Okay? And when we compare that with the blue line where we're at now, look at this. Zzz, we're there at the blue line. By doing this, we're going to flatten ourselves out and help us get some time decay then coming in. Not too bad. And I can hear you saying, well, gosh, I still want to make some money. There's no part of this is above zero break even. Well, that's true. However, at this point, you're losing money. You're down 20%. Here's a little thing in OptionVue, and if you accept that and you say, okay, we're starting over today, you can either get out, accept your loss, or you can roll into a situation that looks a little better. Here's in OptionVue, you have a feature called Control M. If you hit Control M in this graphic analysis, it's going to reset this. It's going to remove the notion that you're losing or making any money, and it's going to set this black dot up at the zero line right there. This is something Frank Fahey likes to do a lot. He's one of our mentors, and he treats every day different, and it all starts from scratch here. He knows what he's been doing during the month, but today is a new day, and here we are. And if we stay in this blue, we have a lot of directional exposure, up or down, or we can roll it into this situation where we're flatter here. We're still bullish, but we do have a lot of room for error. Even if it goes down $16, we're still going to end up making money in 25 days. You see that? So Control M resets the gains and losses to zero, and you can now make perhaps a different type of decision with that kind of perspective. Okay? Now, what if you're making money? What if you're making money and now you want to protect your gain? Okay, well, two things you can do. Exit and just take your gain, pocket it and go. Maybe even scale out half, something like that. Or you can do what's called a free trade. A free trade. Again, we're going to begin here. We're going to go to Apple or ABC stock, whatever, at 330.67. We're paying $23.90 for this call. We walk forward in back trader to a point where now we're making $6-ish. See that? So we're going to go ahead and we can either exit, okay, just get out, take our profit and go. What did we buy this for? $23.90. Here's an idea for you though. We paid $23.90 for this. It's now at $29.30, and the next strike up is at $26.20 and then $23.25. Here's the deal. When the next strike up, all right, can be sold, all right, for more than what you paid for this one, you can then sell this for that amount greater and collect a credit and have a cash flow. So what's this doing for us? Okay, basically you're creating an in-the-money credit spread, or it's a debit spread that's doing very well. So let's just take a look at this. When we analyze this, there you go. We've now locked in our profit. No matter how far this thing plummets, we're going to collect that net credit that we've been. Remember, we bought it for $23.90. Okay, we can sell this for $26.20, and now our net credit, our net requirement goes to zero. We've taken all that money off the table, we're selling this for more money than we purchased this for. So we have a net credit that's in the bank that's guaranteed good to go. These can all expire, get exercised, redone, whatever. We're going to make that much money. Okay? So the thing is we have a little more left over in terms of some time decay benefits, so we can extract more yield just from time decay in this case. We still want to be bullish. We have some room for error, and we've locked in our profits for sure, at least at a certain level down there. That's called a free trade. You make money on your call and then sell another strike for the same amount or more. Boom, you're good to go with your locked in profit. Okay? Oh, and that's the comparison on a yield basis. And you can kind of see we've locked it in. We've locked our profits in. All right. And if time goes on, we've locked in this amount. What we're yielding, though, is the potential for some crazy gains if it keeps blasting off. But that just depends on your analysis. Okay. Finally, quickly, introduction to order types. Okay. You can have a market order where you buy at the ask and sell at the bid. In option, you can configure your matrix to show the bid and ask. And when you put in a market order to purchase an option, it's always going to go and look at the asking price, and that'll be the price you get filled at. Okay, is that asking price? 9 times out of 10, depending on the electronics and how fast the prices are changing, when you click, that's the price it's going to look to. Okay, now when you sell an option, or excuse me, here we go. And if you were to sell, you would sell at the bid over here. You would sell at the lower price. All right, now the other market, or excuse me, another order you can put in is a limit order. Okay, a limit order. And we suggest using this aggressively in options because sometimes these bid and ask spreads can be very, very wide. And if you just put in market orders, you're going to end up paying a lot. Some of them are going to be 10, 15, 20%, or even more sometimes. I mean, can you imagine paying a real estate? I mean, you're buying an asset here, right? What does your real estate agent charge you to sell your house for you? 6%, 5%, something like that? All right, well, here you're buying an asset, and could you imagine giving up, what, 10, 20% or more just to buy this asset? So what you do is you use limit orders. You try and get filled at a price in between the bid and asks. So we suggest using limit orders aggressively. The duration setting of your order. It could be a day order, good for that day only. All right, if you forget about it, it's sitting there. Well, it expires at the end of the day, you're out. Or you have good till canceled. It'll carry over day by day by day, and you have to go in and actually cancel it then to get rid of that order that could be sitting there. Or it could last until the option expires. Also, you have conditional orders. And I like using these when in liquid markets like the spiders. Okay, an order gets triggered when the price of the security hits a certain level. Spiders go up to here. I want my order to get executed at the market. Okay, which is fine if you have a market with penny-wide spreads between the bid and ask. All right, the broker rules vary on the extent of order types that may have a condition. Not all brokers allow all order types to have a conditional order. Some of them, they vary broker to broker, so you'll want to examine that. Finally, folks, if you were to sign up for this session and get the $99 beginning class, intro class, you would get a mentoring session with Ken Dole, and he will have you do homework. He'll have you watch this, do homework. You'll get together with him, cover the parts of your knowledge that might be lacking. We can get into some of the positions you have on. We can't give personalized advice, but we can educate you into our money management models and kind of compare the two. But we can't give personalized advice, but we can compare our models to what you're doing. Finally, if you're a client of OptionVue, go to the help section, click on tutorial videos. You'll learn much more about OptionVue by watching those. and learning exactly how to use OptionVue in a more detailed way. To wrap it up, here are some other resources you should consider. You have down here in the bottom left, this is the free ebook we're giving out. Jim Graham and I wrote this, Simple Steps to Option Trading Success. Len Yates produced this book, High Performance Options Trading. He's the founder of our company. Natenberg, it's a classic, Option Volatility and Pricing, as is this one, Options as a Strategic Investment. These are 4 awesome resources that you should consider in moving your education forward. All right. Any questions, comments, etc.? That does it for us. And I appreciate you guys joining us and listening in. If you're watching the recording, we would love for you to become a client of OptionVue, discover options mentoring, and take it to the next level, whether you're a directional trader, non-directional. It's all good. Also, finally, we also have a blog that I produce and Frank Fahey produces every week. You can go to discoveroptions.com, click on the blog, and we have created a YouTube channel now that will have a weekly video of myself going over the prepared mind. It's called The Prepared Mind, and it's our YouTube channel, and I give you a market outlook, market likelihood report every week. It's posted every Sunday night or so, and you could go and subscribe to that channel and get a notice as to when we publish that video. And then by Monday morning, we also are publishing Frank's Prepared Mind blog from the Discover Options website, but that's something weekly we do for free for everyone that's interested. Okay. Folks, thanks so much for joining us. I certainly appreciate it. Have a great rest of the day, and we'll see you down the road. Bye-bye.